Okay, so in the next few moments, I'm going to share with you about ETF, and these are the three objectives I would love to achieve with you all. Number one is what is ETF, and number two, where to find the best ETF, and number three, where are the potential returns. All right, so that's basically the three objectives that I want to achieve. Now, this is a S&P 500 tree chart. So in this chart, there are altogether 503 companies in there. So for most of us who want to invest in these US stocks, in the US companies, we will have to, go through several steps, intelligent steps to screen the stocks, financial statements, company announcement, company corporate actions, and what are the trends, So all these requires time, or all these require time. Now, no doubt that in today's world, Google actually give you quite a good source of, finding all this information. But the problem is that out there are so many conflicting informations. Unless you are very certain, unless you follow the trend of the company, unless you do a proper steps, understanding what is the company going forward, likelihood is that out of 10 companies, you may pick, 6 are probably doing pretty well. Then probably 2 just moderate, and the rest maybe just not doing too well. So with this kind of way of investing, I'm not saying it's no good, but it's just that it takes up too much time, especially for working adults, whereby you only have limited time per week, to look at the stock market. Or maybe if you are new to the stock market, you are not familiar with the US market, which is a complete different animals. And then if you want to participate in such actions, going into a stock market just like that, it becomes something whereby you tends to be a little bit more timid, going to it. So that is what current situation is. Now, the thing is this: when we invest in ETF, what does the ETF stand for? ETF stands for Exchange Traded Fund. So what it does is that it's very similar to, like a unit trust. And each basket basically holds a couple of companies, and you are actually investing in the basket of stocks, in the basket. So one ETF that will be consist of maybe 100 stocks, 20 stocks, 50 stocks, and things like that. Now, the advantage to invest in this ETF, I think the first thing is like what I mentioned earlier on, time, right? Why is it so? Because if you go up there and try to screen, 20, 50, 100 companies and try to put that in your portfolio, that really requires a lot of time, knowledge, expertise, and so on and so forth. Whereas if you invest in the ETF, basically you just buy one basket and it consists of those companies that's inside the basket. Number 2, flexible. Now, what I mean by flexible, because if you think about this, if you go up there and buy a unit trust, I'm not saying unit trust is no good, but I'm just trying to say that if you go up there and buy a unit trust, the price itself is not transparent. And then the thing is that even at the point of time you find that it is a good price to sell, you want to sell that unit trust, you have to call your agent, you have to call your bank, and you have to place a sell order. And then 2 or 3 days later, the transaction will take place, and then the money come back to you. So it is not that flexible compared to ETF, whereby ETF is basically listed in the stock exchange. The buy and bid and ask price is always there. You can look at it and you decide, what is best price to buy and what's the best price to sell. Now, the third thing is basically cost, right? Because if you think about this is actually quite straightforward. Investing is like doing business, right? And if you do business, in order to maximize your profit, you need to look at your expenses. You need to look at your costs. And then let's say, supposing you're going to invest in 50 stocks, imagine you're going to do 50 transactions, right? That is going to cost you a lot of money. Whereas 50 stocks inside the basket, you only need to buy the basket, your transaction cost is only one time. That indirectly reduce your cost of doing business. And third thing, risk diversification, like what Emin said earlier on, if you have your 90% of the wealth parked in Singapore, and you want to look at other areas to invest, either geographically or different asset class, ETF actually gave you that sort of a risk diversification, in terms of diversify your risk. So these are the four main benefits that you can get out of ETF, and that is why we should seriously consider ETF if you are looking in the directions whereby any of these four. Now, because of how ETF is being structured, so we can actually construct ETF as a portfolio, and this becomes very flexible tools for us to do things. So for example, in front of you, you have a 3 basket, and obviously we are not going to put all the eggs in one basket. This is common sense, right? So what we want to do is that, let's say, assuming basket, if you are talking about geographical, spread, risk diversifications, the first basket can be, Singapore, because that's where you are living, you're residing in. The second basket can be, let's say, the US, and the third basket can be China, right? So for example, like in this recent few weeks, and if you all read the news, you know that China's stock market is taking a big hit because of policy change, a change in focus. Stock price has actually gone down by nearly approximately about 20 to 30%. Hong Kong has actually come down about 20 to 25. In fact, year to date, Hong Kong stock market right now is the worst performance in Asia Pacific. Now, imagine that if you would have invest everything in China, at this point of time, your portfolio will be suffer quite a big loss, right? But again, if you use this basket to strategize, that obviously, lower down your exposure to China and allow you to let your portfolio stay afloat. And then, of course, in between, we readjust the portfolio. That's what I mean by strategize, and strategize can mean a lot of things. It can mean industries, sectors, or it can mean even different type of asset class. For example, you can, if you like cryptocurrency, you like blockchain, that basket can be a blockchain related, AI related type of companies. And the second basket, if you like something like e-commerce, then you will just concentrate everything on e-commerce. And so all these different baskets will actually give you different returns, and such returns will give you the kind of gain, the objective that you want, which is really, really important. So ETF is, if you want to look at it in a simple way, it can be simple, but if you want to really drive it efficiently, it can actually help you to drive your growth pretty well. So basically, that's basically using basket to strategize the ETF objective, right? The growth objective. Okay, at this point, you have any other question? If I'm more than happy to take them. If not, I will go on from here. No? Okay, good. Now, so there are different type of ETFs in the market. So not all ETFs are made the same. And in today's market, in all exchange globally, we have about more than 8,400 ETFs, in different exchanges. And because how ETF is being structured, we basically can categorize into few categories, So for example, we can look at the index type of market cap ETF, or if you like fixed income, in other words, it's like what Emin has mentioned earlier on, every month you like to see some incomes come in, either to sustain your lifestyle or to sustain your expenses. You may just want to look at the dividend ETF, or you can look at the sector ETF, such as, finance, the finance sector, the energy sector, the consumer discretion sectors, or things like that. So you can look at those sectors, and sectors are typically when you are, involved in it. For example, your day job or your expertise lies around that area, then you probably will have more information than the rest of of other people. For example, in healthcare, you are working in and out in terms of what are the ongoing trend, what is the COVID situations, what are the things that need, what are the companies is buying this, what is the companies buy that. That basically, that kind of information, although you can't pinpoint the companies because for some reason you don't have that information, then you can actually invest in what we call the healthcare sector, type of ETF, and that will actually give you a pretty good growth as well. Then you have your international ETFs, like for example, you can look into Japan, Korea, India. For me right now, I'm so much into India and I love it very much. So these are the international ETF. Then you have your active managed ETF like ARKK, Cathie Wood. If you're some of you who are already invested in ETF, you all may already heard about her name. So Cathie Wood is more on innovations and futuristic type of ETF, and she actively managed this ETF on a daily basis. So that ETF has done exceptionally well last year. And this year, of course, they are slowing down a bit, but then again, everything is on track. So that's basically on active managed ETF. And finally, the last one is thematic ETF, meaning to say that you are focused on one subject. In today's world, if you read the papers, it's all about clean energy, it's about ESG, it's about EVs, and it's about AI. So these are basically all these very focused type of ETF to invest. So all the types of ETF up there are plenty of choices, and how you put them together to drive towards your goal is very, very important. So for example, if you are looking into, let's say, more than 15% capital gain per year, then obviously you want to pick something, the ETF that can grow along those lines, all right? That will basically help you to achieve the goal. So I will just give a very good example. This is basically a S&P 500 technology ETF. This is a sector ETF. And you look at how it grows from last March, all right, all the way to to date, which is very impressive growth, and this is not Nasdaq. This is nothing about company. This is basically a sector by itself. It continues to grow. Now, this is going to take away. This is going to take away for you. All right, this is a takeaway for you. Is that if you believe, and listen carefully here, if you believe that today the world we are living in now, the things that we are using it right now, the technology we're using right now, is going to be updated in 8 years' time, in 10 years' time. If you believe in this, then you have to put your conviction in this and say that, yes, technology is the way to go, right? But of course, you say, no, things won't be that fast on now. Everything is, it's only on the paper only. Okay, that's fine. We can choose other ETF, but that is where I'm coming from. Technology ETF is something that you believe. You may not understand the technology, but if you believe in it, you look at the performance and you can start to invest in it for capital gain, right? So in this ETF, what does it consist of? If you look into the spread, it consists of different sectors like software, computers, semicons, communications, electronic investment machineries, and renewable energies. And the biggest one is actually on software and IT, right? And this shows that how much weightage has been put on this industry alone. The type of company that this ETF is in includes of Apple, Microsoft, NVIDIA, Visa, PayPal, MasterCard. So it comprises of hardware, software, payment companies, security companies, and semiconductors company on the top 10 holdings of this ETF. So that shows you that how this ETF is being diversified even within a basket of stocks, just to prove my points. So coming back to Singapore, does Singapore has the ETF as well? Yes, we do have ETF. In fact, you can actually find it through now. SGX has come out with a very, very simple and straightforward website for you to screen the price of the ETF itself using the ETF screeners. So first of all, you have to go to SGX landing page, and under securities, you're going to see a price and screener, and then followed by the ETF screeners. So I'm going to show you this as a video because I have recorded it some time ago. So I'm going to show you how it works, right? In this video, I'm going to show you how you use ETF screener from SGX website to help you to pick the ETF that fit your investment criteria. On the SGX website itself, under security, go to price and screener, then ETF screener. You come to this page, says ETF screener, and it has 5 criteria over here based on fund manager, asset class, classifications, geographic, and benchmark. So I'm going to show you an example. Say if you are interested in China, I'll click on China as the geographic, submit it. Here the screener will pick 9 ETF that is China focused. All right. Let's say if I would like to look at the commodity ETF, I will go to commodities. And you can see that gold is one of the ETF that listed on the SGX website. Now you have a different classifications you can play around. The asset class divided into fixed income, commodities, money market, and equity itself. So let's say another example, if I only interested in equity, and let's say I want to concentrate on Asia Pacific region, select that, click on submit. You'll see that there are actually 2 ETF that fit into that criteria. All right. So this is how we can select a ETF using the ETF screeners from SGX website. You can pick the best performance ETF using the screener. Over here on the right hand side, there is a tab that says top performing ETF by NAV. Underneath there's a performance of selections, right? So you can select anything from 3 months to 5 years. So typically what I'll do is that I will only select 3 years because 3 years is a good gauge to decide how the ETF performance over a period of time. Click submit, and it will give me a list of ETF that's listed from the best performance to the worst. By using all this information, it helps me to pick the correct ETF to construct a ETF portfolio. Okay, thank you myself. So this is basically something that you can take away from tonight's webinar, is that to learn how to pick a ETF from the SGX screeners, and from that screener itself, you can actually come out with a very simple but very effective ETF portfolio that can generate incomes immediately. So for example, a typical RSP ETF, by the way, RSP stands for regular saving plan. So a typical RSP ETF income will give you 4 to 5%, and it divided into 4 different classes, all right, 4 different asset class. One is the equity, one is the REITs, and the other one is commodities, and the other one is bond. So in this portfolio, I allocate 50%, all right, to equity, 30% to REITs, and 10% to commodities, and then 10% to bonds. So with this kind of portfolio, I will be able to generate, 4 to 5% kind of return per year, and that will actually sustain my kind of expenses. So for those people who need income, who need income, this kind of portfolio is pretty good, because you don't really have to take too much of a risk. You don't have to worry about, the price will go up or down, volatile and things like that. And it will continue to give you the kind of a yield that you want. That is basically a fixed income portfolio. Now, on the other hand, if you have a bit of runway, on doing, a more of a growth type of portfolio, because growth will require years to grow, right? So we need a bit of runway. And then basically this ETF portfolio will be shifted, into from something which is more of a conservative to a little bit of aggressive, whereby I will allocate 20% on Singapore equity, 20% on Singapore equity, which is the STI ETF, and then 30% on REITs, all right, and then 30% on team investment. So it's like a thematic. So it can be anything on technology, e-commerce, EV, green energy, that sort of things. And then another 20% on the market cap kind of index funds, which is a US equity. So with this kind of portfolio, I would expect this portfolio will generate between 8 to 12%. And that's what I mean earlier on when I was talking about ETF. How do you strategize? It's really depends on your goal and how you put them together. And by putting, it's the same ETF, but then if I would do a little bit of adjustments, you can see that I can turn from income portfolio to a growth portfolio with quite a few simple changes. And over here, I'm only talking about 4 ETFs, right? Nothing more than that. So to illustrate what kind of a return that I'm expecting. So let's say, supposing I'm looking at the income portfolio on a regular saving plan, $1,000 per month with 4% growth per year. So for 10 years, so 1,000 per month, 12,000 per year, 10 years is $120,000 investment in total. But the return that you can get out of these 4% is 156,000 in total. All right. So that is the kind of return that you can get. And it's not a lot. I mean, in today's money term, it's not a lot of money, but then it beats better than, it beats the bank interest, which basically give you 0.25, 0.4, that kind of things. So this is one way. Now, if it tends to be a little bit more aggressive, let's say if we look into 17% growth per year, and we are looking into more towards technology-driven type of things or software type of ETF, the same $1,000 per year, per month, with 10 years projections. Now your $120,000 that you invested, you were expecting that this portfolio itself will grow all the way to $316,000, right? So it's the same concept, same ETF, but depends on how you shift it, and all these results will give you very differently.